Hi everybody, welcome to the Finance This, Property That podcast. My name is Dion Fernandez and I am a mortgage planner and finance professional. My goal is to empower financial legacies for generations, and I look to do this by using my over 13 years experience in finance and having special guest speakers like financial planners, accountants, buyer's agents, family lawyers who are experts in their field to provide knowledge and free education. And without further ado, let's get into our episode today. Hey everybody, welcome to this episode of Finance This, Property That. I've been getting a lot of questions and I've been seeing a lot of scenarios from my ideal clients that have been coming through. And I just thought I'd share a few hints and tips and some real life case studies, because if you are in the same situation, I hope it resonates with you and we can have a chat. So my ideal client, if you don't already know, time poor industry professional like doctors, lawyers, solicitors, you're self-employed or you're a business owner and you're basically stuck. A lot of my clients have been told no. They've either been told no or they're with one bank and they've never explored. And when they come and see me, they see a lot more options. Now, what I want to go through today is self-employed and why are they stuck, and how to get lenders to say yes, and how I do that. So if you are a business owner, sole trader, you are in the medical law professional as a partner, or even contractors, developers even, this is for you. So let's get into these three talking points where I want to go through today. Why are self-employed? Why is self-employed treated differently within bank to bank? What are the different ways of presenting your income properly? And let's get the elephant in the room. Alt-doc lending, what is it and when does it work? And I'm going to give you a case study of one of my long-term clients on how we've done this and got them into their dream home. And also, I'm going to run a few tactics on how to improve your serviceability. There's a few cool rules. Like, I personally don't think that self-employed policy is actually being made harder. I reckon it's actually being made easier, but easier for the people that actually have the information to be able to do that. So that's where you need someone like me that's across all the lending policy. So let's get into it. In a nutshell, so why are self-employed clients treated differently? Well, by default, you're seen as high risk because you are sourcing your own business. You are you get a lot more flexibility with your income. And look, quite honestly, a lot of business owners aren't organised, or they're also getting the wrong advice. And yes, it's great that you're focused in on your business, but financials and the cash flow of the business is all part of focusing on the business. So, a lot of self-employed clients, you can add things back. So you can run a lot of your expenses through your balance sheet. So that's where sort of the company structures and trust structures also confuse a lot of credit teams. They some banks or some credit analysts don't understand it. Some brokers don't even understand complex self-employed. So it is a little bit of a tricky situation. But I always say that you're either spending money or making money. There are two types of financials. You can have a financials for tax purposes, or you can have a financials for lending. Sometimes you can get the really great mix in between. But if you have your goal for the tax is really what determines it. And that's the conversation you need to have with your accountant and your broker, because if you've got plans to borrow, you need financials to borrow. And yes, you'll pay more tax, but that means you've made money. But if you want to minimize tax, then you'll have a financials for tax, but you can't complain that you can't borrow the amount of money with the cheap money. Now, I'm not saying you can't borrow the money. It just won't be the same rates as a retail lending. And I'm going to get into that in a second on how you do that. The other big issue with self-employed clients that I find is they don't present the income properly. So what does that mean? So a couple of red flags. This is what the banks like to look for: 2 years financials. And the reason why we look at 2 years financials is to show what over a time period of 2 years, what the consistency looks like. Lenders are looking for consistency, not one-off Hail Marys that you had a really good year, but then you can't back it up the next year. So how do we do that? How do you present it properly? Well, let's have a look at the red flags. Number one red flag is declining income without a purpose. So I have a couple of clients where they had a really good year one. Year two, the sales weren't as much and their expenses were down. And they're actually, when you actually look at it, they were going backwards. But then all of a sudden in the current financial year, they'd got back up. Now it's all about how did I present that to the bank? Well, I presented it as, we asked the client what was going on. They actually took 3 months off because they had some medical issues. That's a great mitigant because we could actually see in the most recent year, yes, there was a decline. The year before it was pretty good. But in the current financial year, using things like BAS, interim financials, and the help of the accountant, we could show that it's gone back to normal, and we actually found a lending solution with one of the major banks. And it was all about how we presented that deal. The other red flag that I'm seeing is around when you're paying yourself, but it's not consistently paying yourself. Now, I'm always a big advocate of pay yourself a salary, and that is coming up later on in this podcast. But if you're paying yourself a salary, pay yourself a salary. Be consistent, not inconsistent, because that comes back to what are the banks looking at? They're looking at 2 years financials. They're looking for consistency in what's happening. It's the same as if you're paying yourself a wage. It's got to be consistent. It's got to be going into your bank account. It can't be a wage on paper. Please don't do that. So what happens when you don't have the financials to back up the income? I see this all the time, and one of my specialties is around alternate documentation lending. Well, some of you may be asking, well, what is it and when does it work? All right, so here's the breakdown. It really works when you haven't got a good set of financials or 2 years of financials, but you're actually doing really well. You're doing really well in the current year, but we can't obviously extract the financials to do that. And we've got some backing up with your accountant. So alternate document lending is as what it says. We use alternate documentation, e.g. client declaration, and we back that up with 6 to 12 months worth of BAS, depending on the lender, or an accountant's letter. Now, I still see your financials. I still need to look at the calculations. You can't tell me that you earn $1 million when you don't earn $1 million. I still need to do my checks and balances and make it compliant. So you can't just declare any income, because if you are declaring that income and your accountant's giving you an accountant letter, 9 times out of 10, your accountant will be called to say, hey, did you know that your client has declared this much income? They're borrowing this money, and are you aware of that? And is that reflective of their current position? That's in a very high level way. So you can't just declare what income you want. So classic example, one of my really long-term clients, I have done their portfolio from day dot. I've just recently restructured it in the last 12 months, got them the equity out. They've just sold a property, got a bit of cash. Their goal this year was to get their dream property. Now, my client previously was PAYG and self-employed at the same time. So full-time PAYG, self-employed. His wife was also permanent part-time. Fast forward to this current financial year, ditched the full-time PAYG job, went all in on himself. I'm so proud of him because he's absolutely kicking goals. It is a slog, and I can relate. His wife also left her paying job to be able to help the business, which actually gave her a better work-life balance and able to spend time with her daughter. Now, they have found their property that they really want to live in, they want to move into. They've got awesome equity in their existing property, but I can't extract the equity and give them a better rate because they don't have the financials this year. Now, how did I go about this? Well, firstly, I planned the exit. So, okay, we need to have this income. This is what we need it to look like. We spoke to the accountant. We're almost there with the financials for 20, and obviously we can't do that till the end of financial year. So August, September, we'll be refinancing out. So that is the exit. But how do we enter? Well, he's had 3 months so far because it's only been three quarters worth of BAS in this current financial year, and he's absolutely killing it. So we've been able to use the BAS calculations, and also he pays himself and his wife a consistent salary. In liaising with the accountant, we were able to find an income that the accountant was happy with. Accountant declaration, customer declaration, alt doc lending, valuation completed, contract of sale. They're able to go unconditional on their property. It settles next week, and in about 3 months' time, when we have the full set of financials, we will refinance them back out. It is a short-term solution, but they didn't lose out on the house. And that to me is a win, and we'll now be planning for their next investment purchase because they've got a lot of equity, and I already know they're going to have great income with full financials in the new financial year. So, off the back of that, how do you improve your serviceability? So, a couple of things. I've just touched on it before. Be consistent with your salary. You don't need to pay yourself a minimum salary. Speak to your accountant. What can you pay? What can you afford to pay out of the business to yourself? Reduce your personal expenses for 3 months. That will put money back in. You could save more money, put your deposits, and it actually looks really good, and it actually shows your propensity to save. Get rid of any unnecessary credit cards. They are the silent killer because they have to use the banks use the whole credit limit, not just your balance. If you don't need it, don't have it. So those are really 3 quick things you can do. But also, I'm going to give you a little Easter egg. Make sure you plan what your financials need to look like for your future goals. So if in the next financial year, after July 1, you're going to buy property, well, you need your financials to reflect borrowing power. So my big call out is if your business is growing, but your loan options aren't, what are you actually missing? You're probably speaking to the wrong person. If you're going straight to your bank, you're only getting one option, and you may not be getting someone as experienced. Come and have a chat to me about your situation. The information on this podcast is very general in nature, but if you want to talk about your own situation and how what are the options for you, come and see me. You can find me very easily at Dion Finance Specialist on Instagram. You'll be able to click my link and book a time to see me. Jump on the podcast website, financespropertythat.com.au. Find me on LinkedIn. You'll see all my content up there. Dion Fernandez on LinkedIn. Jump on the Emerge Finance website, emergefinance.com.au. You can see the bigger team there because I do have a massive team that we all work together. And also jump on and see over almost 350 5-star Google reviews from the Emerge team and myself. But again, if you want to talk, reach out. Doesn't cost you anything. If you've learned something, also share this with your bigger network. But until the next episode, thank you for listening.